3 stocks to buy with absolutely $0 of debt on their balance sheet. That's exactly what I want to go through with you guys today. And a lot of stocks that have $0 in debt on their balance sheet are actually seen as safer stocks, especially during a recession. In this video, I want to cover 3 companies in 3 different sectors that have a strong balance sheet with $0 in debt. Remember to smash that like button here because this video did take a lot of work and research, so I truly appreciate that. And if we can get 200 likes on this video, I'll release another video with 3 more stocks that have $0 in debt on their balance sheet. So that's a challenge for you guys today. Let's see if we can hit that. So the first stock that we're going to talk about is ALGN Technologies, ticker symbol ALGN. So here's a stock I've been covering quite a bit on the channel recently, and the reason that I've been doing so is because I personally believe that this stock is on a massive sale right now. ALGN stock is down around 56% from its highs, yet their business is still strong and revenues and profits are still growing. I'm not going to spend a lot of time here going over their business or what they do. That's easily achievable by a Google search here, and I've made multiple videos on the stock already. So in the interest of time, let's get into the meat of this video here. So let's start off here with ALGN's balance sheet to see what's up. So they have a very strong balance sheet here with around $772 million in cash and equivalents, but this is down slightly quarter over quarter, where last quarter they had around $780 million on hand. This could be because of more marketing and increased competition, which is forcing them to lower prices potentially and spend more to bring in customers. It's still too early to tell, and one quarter does not really make a trend, so we'll have to wait and see how the rest of 2019 plays out before we make assumptions on this. Now, of course, in terms of debt, they have $0 in short and long-term debt, otherwise they wouldn't be in this video. Moving on, ALGN is a strong earnings performer as well. Quarter over quarter, they consistently beat out estimates and surprise analysts and investors with strong earnings. And I'm a huge fan personally of their profitability, and this is shown with their consistent strong net income quarter after quarter. Now what I want to actually show you guys is something different that I haven't really shown in any other video. This is a new feature on TipRanks called the Smart Score. So if you want to see this in future videos as well, just let me know in the comment section down below if this is valuable to you. And don't forget to check out TipRanks as well to look at this information for any stock that you're interested in as well. Links are in the description down below if you're interested. So here's a Smart Score by TipRanks, and you can see for the most part, the sentiment is fairly positive on ALGN despite the stock being down significantly. Average analyst price target is around $259 per share, and investors and hedge funds have been buying. The 2 red flags, however, are 1, the technicals, which is expected after a huge sell-off like this, and 2, the insider activity, which shows us that there has been more selling than buying in the last 3 months. Breaking this down further, we can see that there's some big selling by different directors in this stock. This could be a bad sign in the near term because they most likely know something we don't, and this could be hinting that the stock may be heading lower in the near term. However, this does not mean for sure that the stock price will drop, but it is something to keep in mind if you are looking at investing in ALGN Technologies stock. And you can kind of think about this logically. If the company expects the stock to recover soon and pretty much go back to their all-time highs or close to that, wouldn't it make more sense for them to be buying as opposed to selling? That's just some food for thought right there. Now finally, let's pull up ALGN's charts here, which actually, in my opinion, screams a massive buying opportunity. The weekly shows us that we have found a bottom here in ALGN, and when you combine this with the stochastics, it does show that the stock is severely oversold. These 2 signals tell me that ALGN may be getting ready for a rally, probably back to around the $200 per share level, which coincides with the 200 moving average. I think by next earnings or so, which is late October, we will see ALGN close to $200 per share, and depending on the report, we either move higher in the stock or drop back to the 170. Either way, I'm not making my investment decision here based on this purely, but when I look at their financials and fundamentals and technicals, I'll tell you guys right now that I have been buying ALGN Technology stock at these prices because I do think that it's screaming a value buy right now. So let's move on to our second stock here, which is PetMed Express, ticker symbol PETS. Now here's a smaller company, actually a very small company at around a $300 million market cap, but I still believe they're in a sector that has a lot of growth potential ahead of it. I also believe that pets has a good potential to be acquired by a massive giant company like Amazon, but that's of course speculation and that may never come to fruition. In a nutshell, this company is one that sells pet medication online, and for any owners out there that have pets like dogs or cats, You know that when you go to the vet and you try to buy medication there, it's typically very expensive. So what this company does provide to you is an option to purchase that online and actually save significantly on that medication. So let's pull up Pet's balance sheet here, and we can see that they have a decent balance sheet with around $83 million in cash and investments. But again, remember, this is a very small company. Debt, as expected, is $0 here for both short and long term. But one thing that I don't like here is when we jump to their earnings, you can see that the last 3 quarters, they have missed badly on their numbers. This could be because their main competitor, Chewy, has recently gone public, and investors seem to think that their potential is better than Pets, and customers may be shopping more on Chewy, which is leading to lower profits here in Pets. Competition is usually good for consumers, but for businesses, it usually means that they're going to have to cut down on their profits, and that may be what's happening here with this company. Now jumping over to the smart score here for Pets, things are a little different here than with Align Technologies. Analyst coverage is minimal and is currently at a hold rating, but I wouldn't put much weight on that with this stock since there's no big names and big firms that are covering this. Hedge fund activity, on the other hand, has been good, and funds increase their position, leading to overall positive sentiment. The red flags here are the technicals, which we'll see in a second, do not look very strong, and the asset growth, which is actually declining year over year. This again could signal more turbulence ahead if this trend continues, but if they can revamp their website like I've discussed in previous videos and start a new marketing campaign, they could have a chance here to compete head to head with Chewy. Now the charts here for Pets are just crazy, with the stock down 74% from its highs. Recently, however, they are forming a bottom, and this could be an ideal time to enter the stock. This could really be seen as a recovery play, but it all depends on how this upcoming earnings report really goes. Now, I also want to mention that Pets does have a current yield of around 6.71% for the dividend, and this comes with a 57% payout ratio. So I would say that this dividend that they pay is actually relatively safe and attractive. So I personally would not mind having a position here in this company, enjoying that nice almost 7% dividend yield, and just kind of seeing where this stock goes in the next few years. Maybe we don't really go anywhere, but if that happens, I still enjoy the dividend yield. Maybe the stock drops a bit lower, which is the risk that I'm taking on, but maybe the stock actually recovers and we continue receiving that nice dividend. Either way, whatever scenario plays out, I still would not put a massive exposure here to this company because it does pose a lot of risk and it is a very small company, so you got to manage your position accordingly. Now, the third company here in this list is one everyone's heard of. Maybe most of you actually invest in the stock already, and that of course is Facebook, ticker symbol FB. This stock of course needs no introduction, and it's one of the largest stocks in the stock market, or actually in the entire world. They have literally dominated the social media space, and with smart investments like with Instagram, they have continued to grow year over year. Looking at Facebook's balance sheet here, they're currently around $50 billion in cash and investments, and their cash balance is growing rapidly quarter over quarter now as they continue to monetize their platforms. They don't have any long-term investments, but I do think this could change in the next few years as growth eventually slows down for the business. The debt, as expected, is $0 for both the short and long term. Earnings have been consistently strong for Facebook, with them exceeding expectations quarter after quarter, raking in billions of dollars in profits. They have recently had to pay some fines, which decreased their balance sheet, but will still have well over $40 billion on the balance sheet as we saw previously. The smart score for Facebook is among the best we've seen here on this channel. There's a lot of green across the board. Analysts have a strong buy rating at the stock of around $234 price target, which is well above current prices. The sentiment is bullish, but we can see that hedge funds have decreased their holdings recently, and TipRanks investors also have a negative sentiment on the stock currently. Now, even though hedge funds reduce their exposure to Facebook, their overall positions still remain extremely strong as shown here. Again, I wouldn't take this information to heart, but it is worth looking at and making note of if you are investing in Facebook or already are an investor in Facebook. In this case, I think a decrease of 1.6 million shares is fairly negligible for a massive stock like Facebook. Now, the charts here of Facebook show that in 2018, at its lows, Facebook was down around 43%, and that was the ideal time to get into the stock. But even fast forwarding now to mid-2019, the stock is still trading at an attractive price, still down a bit from its all-time highs, despite posting strong earnings consistently. This is a company that is almost like a no-brainer due to their business model, balance sheet, and sheer size. And at current prices, I would still consider Facebook undervalued personally. And I think this is just a theory that in the next recession, we're going to see stocks like Facebook and Google actually start to finally pay out a dividend. The reason behind this is I think that they'll kind of incentivize investors to stay with the stock and not sell off the stock during times of uncertainty. And both these companies have an incredibly great balance sheet to support dividends. But even with that aside, I think that Facebook actually has huge opportunity for capital appreciation, which is another reason I absolutely love this company and this stock. So I want to pose a question off to you now. Which of these three stocks we covered today would you consider investing in right now? In my opinion, if I had to pick one of these three at current prices, I would probably go with Align Technologies just because I believe it provides the best risk to reward at its current price. However, if you're looking for a pure dividend stock, then of course the no-brainer answer here is Pets with almost a 7% dividend yield. However, if you are looking for stability and maybe a little bit of growth as well, then the no-brainer option in my opinion is Facebook. All three of these companies we covered today are in growing markets, and I believe with the right execution, they can become much larger than they are today. Now guys, remember the like challenge we had for this video? If you hit 200 likes, I will create another video with 3 more stocks that have $0 in debt on their balance sheet. Don't forget to share this with a friend as well who's considering getting into the stock market and maybe looking for investment ideas. And don't forget to hit that subscribe button down below if you're brand new to the channel as well. Thank you so much for watching, guys. I appreciate each and every one of you for sticking around for this longer video here. Hope you found some value in this. But either way, don't forget to invest positively. Peace.